Two British expats, both living in Bangkok, both with £150,000 in £1 savings in 2025. One opens a £1 foreign currency account at Bangkok Bank. Money nearby, feels controlled, feels safe. The other keeps it offshore. By the end of this video, you'll know exactly why that decision isn't just about exchange rates or convenience. It's about whether that money is actually protected at all. Here's the number that anchors everything in this video. £6,862. That is the approximate annual return gap between a £1 foreign currency deposit account at a Thai bank and a standard easy access savings account in the UK, on the same £150,000. Not a modelling assumption, not a worst case. The direct arithmetic of rates that are publicly available right now. That number compounds. Over 5 years, it's more than £34,000 in foregone income from one decision that most expats make without looking at a single rate sheet. But the return gap is only half the story. The other half is the word protection. And that's where a Thai foreign currency account does something that surprises almost every expat who hears it for the first time. Thailand's Deposit Protection Agency, the DPA, protects your Thai baht savings up to 1 million baht. That's well established, and most expats know it. What most expats do not know is that FCD accounts, foreign currency deposit accounts, are explicitly excluded from that scheme. The legislation carves them out. Zero coverage. If the bank failed tomorrow, your foreign currency deposits would sit in the general creditor queue alongside everyone else. Not covered, not insured, not protected. Compare that to what your home country offers. In the United States, the FDIC covers up to $250,000 per depositor per bank. In the United Kingdom, the FSCS covers up to £85,000. In Australia, the Financial Claims Scheme covers up to $250,000 Australian dollars. In Thailand, on your foreign currency account, zero. That is the foundational fact of this video. Every other number flows from it. So what is a foreign currency deposit account? And why did Thai banks offer them? An FCD account is simply a bank account denominated in a foreign currency. US dollars, euros, British pounds, Japanese yen, Australian dollars, Singapore dollars, Swiss francs, or Hong Kong dollars, held at a Thai bank. The bank keeps your money in that currency. You don't convert it to baht on deposit. You withdraw it, wire it, or convert it when you choose to. Bangkok Bank has the widest currency menu of any major Thai retail bank in 2025. 8 currencies, including Swiss francs and Hong Kong dollars, which most competitors don't offer. The minimum opening deposit on a savings-type FCD is typically around $500, or the equivalent in your chosen currency. For a fixed-term FCD, where you lock your money away for a set period to earn a slightly higher rate, minimums run from roughly $1,000 to $5,000, depending on the term and branch. UOB Thailand, which completed its full acquisition of Citibank Thailand's retail banking book by late 2023, offers FCD in 6 currencies: US dollars, euros, British pounds, Australian dollars, Japanese yen, and Singapore dollars. If you were a Citibank Thailand customer, your FCD account migrated to UOB. The Citi brand in Thai retail banking is gone. UOB has positioned itself as the premium English-language expat successor, and for many former Citi customers, the transition was largely seamless. But it's worth confirming your account terms if you haven't reviewed them since the migration. K-Bank offers competitive digital banking integration for FCD accounts, useful if you're managing currency positions from a phone. SCB's FCD availability is notoriously branch-dependent. Some branches offer it easily, others don't, and the experience varies enough that it's rarely the first recommendation for expats opening a new account. Now, the mechanics. How do FCD accounts actually work, and what triggers the rules you need to know? The interest rate picture is stark. Thai FCD savings accounts pay between 0 and 0.5% per annum, and that's the gross rate, before Thai withholding tax. Thailand levies a 15% withholding tax on interest earned in FCD accounts. Bangkok Bank deducts it automatically. So on a gross rate of 0.50%, your net rate after tax is 0.425%. On $100,000, that's $425 per year. The equivalent US high-yield savings account is paying 4.25 to 5.5%, up to $5,500 on the same deposit. The yield gap is up to 450 basis points. 450. That's not a small difference. That's a decision that costs a $100,000 depositor up to $5,075 every year. They leave the money in the wrong place. And there's one more operational rule that almost no expat knows until it happens to them. Any inbound foreign currency transfer of $50,000 or equivalent in a single transaction triggers automatic Bank of Thailand regulatory reporting. Your bank handles the paperwork. You don't file anything yourself, but the transfer is flagged and reported. This matters if you're moving large lump sums, a property sale proceeds, an inheritance, a pension drawdown. It's not a problem. It's just a reality you should know before the wire lands. So, when does an FCD account actually make sense? There are genuinely good reasons to hold an FCD account in Thailand. If you're waiting for a better baht exchange rate before converting a large sum, holding it in an FCD account means you control the timing. Your money sits in dollars, pounds, or euros until you decide to convert. If you receive large foreign currency wires regularly and you don't want them auto-converted to baht by the receiving bank, an FCD account is the correct vehicle. It receives the wire in currency, holds it in currency, and converts only when you instruct it to. For LTR visa holders who need to demonstrate the transfer of qualifying foreign income into Thailand, an FCD account provides a clean paper trail. The funds are demonstrably Thai-held, foreign-denominated, and trackable. For condo buyers navigating the FET form requirement, the foreign exchange transaction form that the Land Department requires to process a foreigner's purchase, an FCD account receiving the purchase funds is a standard, well-understood mechanism for satisfying the bank letter requirements. And under Thailand's post-January 2024 foreign income tax framework under POR 161-2566, the currency you park funds in doesn't change your tax exposure. What matters is whether the income is assessable and whether you were tax resident in the year it was earned. An FCD account doesn't shelter you from Thai tax, but it does give you control over when you convert, which has real-world implications for how you structure remittances. Here's the framework that financially sophisticated expats in Thailand actually use. Keep your core foreign currency savings offshore, in your home country or in a jurisdiction with deposit insurance, competitive rates, and zero Thai withholding tax. Open an FCD account at Bangkok Bank or UOB Thailand for operational purposes, receiving wires in currency, timing conversions, satisfying remittance documentation requirements. Use it as a transit and control mechanism, not as a savings vehicle. The distinction sounds simple. It costs most expats thousands of pounds, dollars, or euros a year to learn it the hard way. One thing to remember, a Thai foreign currency deposit account is a control tool, not a savings tool. The moment you treat it like a savings account, you're voluntarily accepting zero deposit insurance, a 15% withholding tax on interest, and a yield gap of up to 450 basis points, all at the same time. Open it. Use it, but don't park long-term savings in it. For the complete FCD account comparison by bank, the full currency-by-currency rate table, and updates as Thai banking regulations evolve in 2026, subscribe to the Bangkok Brief newsletter at thebangkokbrief.com or subscribe to this channel so you don't miss what's next.